Hello. Today we will look at the sectors of the stock market. Please note that the companies shown here are for illustration purposes only, not for you to run out and buy or sell their stocks. If you have such a question, please contact us using the link in the description so that a licensed private banker can help you. The stock market sector is nothing more than a group of companies in a similar industry. You can buy shares in each of these groups, giving you the same rights. But they will react differently to a given event, and ideally play a different role in your investment portfolio. When choosing a particular stock for yourself, look at the specific characteristics of the company in addition to the sector. Even within the same sector of the stock market, a startup will behave differently than a blue chip. We're looking at 10 sectors now, but of course you may come across where these are broken down into further subgroups. Before we dive in, let's look at why it's good to group stocks, and why it benefits you to be familiar with this topic. The first advantage is comparability. Here you can compare companies in the same sector, either in terms of profitability or riskiness. But you can also compare the development of different financial indicators. This allows you to choose the most optimal one for you. Here it is important to compare one in the same sector with another before you get a distorted picture. A service company has completely different asset requirements from, say, a manufacturer. That doesn't make it better or worse, just different. Knowing the sectors will also make your choice easier. These classifications are also basically a business model, showing how a company is likely to react to a particular market event over which it has no influence. The simplest example is the car industry. A regulation or even a development will not only affect car manufacturers, but also the sectors that serves it, but obviously not those that have nothing to do with it. If you expect this regulation or development to be implemented within a certain time frame, you can decide whether that stock market sector is right for you or whether you would be better off choosing another one. With this knowledge, you can more easily put together an investment basket of either fully individual stocks or stocks accessed through a mutual fund that serves your goals. Now that we've reviewed this, let's look at each sector and its characteristics. First in line is the healthcare sector. This is the sector that has a very stable consumer base. After all, everyone either needs or will need this. This sector is huge in itself, so we can break them down further. The first subset is the most obvious, the normal pharmaceutical companies. These companies specifically develop and manufacture medicines, either chemically or biologically. The next group is the stocks of medical device manufacturers. Here you can think of anything from the simplest glove to a robotic surgeon to anything a doctor might use other than drugs. But this also includes a group of service providers. One of these directions just pays for healthcare costs, say, after a contract someone has received through an employer-provided benefit. The other direction is to participate in the actual healing process by providing healthcare services. You can see that the sector is big and broad enough, so you have a good chance of choosing a company that will prove to be a good choice later on. That's not to say that your investment is risk-free. Like all investments, this sector has its risks. These can be general risks, such as greater success of competitors, or they can be specific to that one sector. As healthcare is a highly regulated sector, regulation or changes to it will affect the profitability of the company. It is enough to think that until they get a license, they cannot bring their product to market. Despite the risks, the long-term prospects are very good. The aging population worldwide is helping this, so if you are a patient investor, you have great opportunities. The next sector is the energy sector. An important but risky sector. It includes things like gas, oil, coal, as well as companies that produce processed forms of these, so companies that produces fuel. It also includes the service sectors, which provide equipment for this and energy-related services. The perception of renewable energy in this area is already quite mixed. While companies producing solar panels and solar energy as a form of renewable energy are increasingly included here, many of their competitors are more closely associated with the utilities sector. You may ask yourself, is it a good idea to choose? Energy prices change relatively quickly, which has an impact on the operations of these companies, but also on the global economy. The shutdown due to COVID has shown the impact of this most clearly. The quarantine has brought transport to a standstill, which has also led to a significant drop in demand for oil. This has led to a number of oil companies in serious trouble, with more than one of them going bankrupt. If you are looking to invest in this sector, diversification is a must. Even if a company is performing well, it should not be overweighted. The first thing you should look at is how they manage their money. For you, the more conservative method is better. As the operating environment can change rapidly, they cannot manage their finances aggressively, as this can lead to serious liquidity problems later on. This applies to dividend payments, borrowing, and anything else that affects short-term solvency. The next thing to look at is production costs. Needless to say, the lower the better. Be sure to build this into the price of the product, and if demand drops, the higher priced one will be crossed off the list first. If they are less exposed to changes in price levels, they can operate more stably. But also look at your debt rating, choosing the most stable one possible. The next sector is the consumer goods sector. Here we need to further disaggregate and distinguish between consumer staples and the more luxurious items at the other end of the scale. Innovation is a little distant from consumer goods sector, but its products are evergreen. This means that demand for them is stable. Think here of the food industry, tobacco, soft drinks, household products, and the companies that distribute and market them. If you choose a larger company here, you may enjoy regular dividend payments. The other group of companies in the sector are distributors of luxury consumer goods. Here too you will find the same groups as above, but at a premium quality. Their business model is based on the assumption that if you are rich, you are likely to expect and pay for a different quality of food, clothing, and even cars than if you have no money. These are the companies that consumers spend on not because they have to, but because they can afford to. Accordingly, the demand for these companies' products is cyclical, and the exchange rate follows suit. Next in line is the IT equity sector. This part of the equity market sectors covers companies that are involved in either software or technology implementation. It also includes semiconductor and chip manufacturing. In short, anything that is a widget or that makes a widget work. If you're looking at this sector for yourself, there's no easy way to do the analysis. This is one of the most difficult sectors to analyze, so it's easy to take risks you didn't want to take at the beginning. Since many companies are not profitable, you won't see much benefit from the ratio of stock price to earnings. In most cases, you can make the most use of the revenue growth. After all, it is precisely there is no profit because they are reinvesting everything back. But as time goes on, they need to be more and more efficient, especially in sales. This time can be as much as a decade. Let's move on to the real estate sector. As the name suggests, it deals with real estate. It includes several branches, such as the development and implementation of new real estate projects, the management of existing real estate assets, or even the acquisition of tenants. But you can also include anything else that also works in real estate. These can be large office buildings or even real estate distributors. If you choose this sector, you can also expect cyclicality. Real estate is a capital-intensive area, so this is something that both individuals and companies will postpone in a volatile economy. The same is true for rental companies. When the economy recovers, more companies is expected to rent either office or warehouse space even if they have an online presence anyway. However, as the economy slows down, it becomes less important. The next sector on the list is the industrial sector. It covers a wide range of sectors, the common feature being that it usually requires the use of heavy machinery to operate. Examples include construction, engineering, automotive, airlines, railways, waste processing, transport, and companies that manufacture the equipment and machinery they need. The industrial sector is cyclical and highly exposed to the current state of the economy. Economic downturns or slumps can easily reduce demand for their products and with it their exchange rates. For this reason, you should carefully consider the company in terms of stability before making your selection. Credit ratings, operating costs, or even the existing credit portfolio will help you. The latter is also important because these companies typically operate with a high capital requirement, so the amount of capital they need to borrow will be also high. And this will certainly have costs. Fortunately, the sector is just large enough to allow you to diversify. The next sector on our list is the communications sector. Some of these companies were previously classified in other sectors because there is some overlap. In this sector you will find, for example, telecom operators, mobile communication operators, or even media and entertainment companies. In addition, if you choose this sector, do not just choose an arbitrary other company from the sector for comparison, as it is a very broad area. Instead, compare your chosen company with others in exactly the same industry and, if possible, at the same stage of growth. When making your selection, consider whether you prefer dividends or whether you prefer capital gains. Telecoms companies are more likely to pay dividends, although their share price grows more slowly. Information technology companies tend to grow faster. Of course, you should also look at the stability of their operations. This will ensure their long-term survival and growth. Next in line is the utilities sector. The most familiar area. After all, you probably use their services yourself every day. That is water, sewerage, gas and electricity suppliers, distributors and suppliers to residential and business customers. If you invest in this sector, their share value will remain stable due to very stable demand. Make no mistake, these companies are not dead fish, but their share price is less volatile. The stable inflow of income, even guaranteed by the government, allows them to pay above average dividends. Before you rush out and buy the stocks of the first utility company you can get your hands on, take a look at its performance. Although it is lower risk than many companies with similar plant sizes, careful selection is essential. Let's move on to the commodities sector. This includes companies that supply other companies with raw materials or packaging materials for their production. Accordingly, here you can find chemicals, building materials, containers, packaging materials, mining products, or even paper products manufacturers. This sector of the stock market is important for investors because it either facilitates or enables the production of products that are essential for everyday life. However, this does not mean that you can invest once and be guaranteed to get rich. Manufacturing companies are significantly affected by the current state of the economy, so demand for raw materials is cyclical. If the economy weakens and fewer products are needed, obviously the demand for raw materials will fall, and with it their price will sink. You might have guessed that if the price of a commodity falls, the profits of commodity companies fall, and so does their exchange rate. Speaking of profitability, let's move on to the financial stock market sector. Most people think of banks here, but here you will find all the companies involved in money management. Apart from banks, there are, for example, insurance companies, brokerage firms, financial service providers, financial technology companies such as PayPal or Visa, cryptocurrency companies, yes, Bitcoin for example, and even mortgage companies. If you are looking to invest in this sector, you should know that it is a relatively well-regulated sector and there is a lot of demand for it. But that doesn't make it risk-free. So chew diligently over all its efficiency indicators, and even the other indicators. After all, the banking sector is vulnerable and cyclical. If unemployment rises, the proportion of loans that are not paid or have already been cancelled increases, which also worsens the bank's prospects. As no crisis lasts forever, financial stocks are more suitable for long-term investment beyond 5 years.